Let's start by talking about value, not just in trading, but across industries. In the business world, companies are measured by their intrinsic value. In real estate, properties are bought and sold based on perceived value. And in the markets, the concept of value is no less crucial. Warren Buffett said it best, quote, "Price is what you pay, value is what you get," end quote. Now, here's the problem. Traders spend so much time comparing current price to previous price, but professionals, the smart money, are focused on a different question. Where is the market building value? This focus on value is a cornerstone of institutional trading. Unlike retail traders who rely on static concepts like support and resistance, institutional traders treat these zones as dynamic value areas shaped by the flow of real orders. For example, hedge funds or banks don't just look at price action in isolation. They analyze whether the market is building value higher, lower, or sideways. One of the key tools they use to do this is volume profile. What is volume profile? Volume profile is a visual representation of the market's activity at each price level, derived from the depth of market data. It shows where the most trading has occurred, creating three important components. The value area high, the upper boundary of where 70% of the volume is concentrated. The value area low, the lower boundary of that 70% range. And the point of control, the price level with the highest traded volume, often representing the fairest price for buyers and sellers. By focusing on these areas, we can identify whether the market is establishing value higher, lower, or sideways, providing critical insights into market behavior. And here's the best part. Unlike the subjective nature of support and resistance, volume profile gives us an objective and factual approach to analyzing the market. This is why institutions rely on volume profile, because it's rooted in real data and reflects where smart money is most active. For example, Barclays or Deutsche Bank, which are responsible for billions of dollars in daily forex trades, analyze these zones of value to determine their points of interest. By doing so, they gain a competitive edge. Compare that to retail traders, who often focus solely on price patterns or arbitrary levels that lack consistency. This disparity is why institutional traders dominate. They're not just reacting to price, they're proactively identifying areas of interest where value is shifting. So, since we're implementing a Wyckoff and VSA approach, it's only logical to start by identifying areas where smart money seeks value. Wyckoff emphasized the importance of accumulation and distribution zones, while VSA focuses on the volume dynamics that happen at these critical levels. The value area high, the value area low, and the point of control are perfect tools for pinpointing these zones because they reveal the areas where institutions are most likely to get involved. While volume profile has many advanced topics, such as poor highs and lows, single prints, delta nodes, and volume profile shapes, we'll keep it simple because the most critical takeaway is this: the value area high, low, and point of control are the best areas to apply Wyckoff and VSA principles. When price is accumulating or distributing near these levels, we can anticipate the markup or markdown phases, which represent smart money's true intent. These phases provide opportunities for us to align our trades with institutional activity. However, when price reaches these areas, it's equally important to monitor volume dynamics to confirm smart money's interest. This is where volume profile and VSA work together. When volume confirms institutional activity at these levels, it sets the stage for powerful, high probability setups. And that brings us to our next key metric: climactic action.